Hey guys, welcome to the second part of Chapter 1 of the CA Tax module, in which we'll be focusing on residency. Same as before, there's a separate set of notes for this topic, so please download these before from the website if you haven't already. So let's dive into it straight away. So in this chapter, we'll be mostly talking about the differences between a resident, an Australian resident for tax purposes, and a non-resident for tax purposes upon different types of tax. What's the impact of these different categories, and also how we deem each different category as such. What are the tests to determine whether you're an Australian resident or non-resident for tax purposes? So first of all, let's talk about the implications. The ATO obviously prefers that you are deemed as an Australian tax resident because it casts a wider net upon what they get their hands on in terms of taxing. So, for assessable income, Australian residents, they are taxed and assessed on all of their worldwide income, not just in Australia. On the other hand, foreign residents, they're only taxed on what income is earned within Australia. Now, for the tax-free threshold, this is one of the few benefits that tax residents do get, is that if you're only under the lowest tax threshold or tax-free threshold, you don't have to pay any tax on that component of your marginal tax rate. So for Australians, they get a marginal tax rate currently of $18,200, whereas foreign residents do not get that benefit. They have to pay tax on all of their income. They also have a slightly different marginal rate, as you can see here. So Australians, now I haven't written down every single marginal rate here because there's not enough room, and you'll probably get that excerpt separately in the exam. But generally, Australian residents have a lower taxable income. They have a lower marginal rate than non-residents do. Foreign residents have a no tax-free threshold, and they also pay slightly higher rates in the thresholds. So Medicare levy, Australian tax residents have to pay what's called the Medicare levy, and that's basically 2% on your taxable income goes towards providing free healthcare. There's also a Medicare levy surcharge for people above a certain income threshold. If they do not have private health insurance, they have to pay this threshold. It's basically an incentive to put less strain on the free healthcare model by shifting some of the high income earners over to private health insurance. Now, foreign residents don't have to pay this levy, and it's kind of obvious because they're not going to be benefiting theoretically from this free healthcare. So what else? There's dividends, interest, and royalties. So for foreign residents, there's a thing called withholding tax. It's basically when you get your salary, for example, you have a PAYJ withholding. It's the same thing as that. It's an amount that's withheld from the income. That's kind of an incentive for individuals to lodge their tax return because they'll get that credit back once they lodge their tax return. It's basically on the assumption that foreign residents might not lodge their tax return. We might not get that money back, so let's withhold it right when we're paying it. So Australian residents don't actually have to do that because it's assumed that they would include it correctly in their tax return. And the last point is just on CGT. So Australian tax residents, they have to pay CGT, same as their income, assessable income on all of their worldwide capital gains, all of their worldwide assets, and they are allowed the CGT discount. Foreign residents, on the other hand, it's interesting. They're only assessable on taxable Australian property, which basically means direct interest in Australian real estate / land, or indirect via shares, for example, if they own shares in a land banking company, for example. Now, they actually got rid of the CGT discount for foreign residents, but only after a certain point, and this date is the 8th of the 5th, 2012, and you can see that in the notes right there. So basically, you have to apportion the period where you can apply the CGT discount. Just keep that in mind for a question involving foreign residents and CGT. The other key thing that they've very recently gotten rid of for foreign residents is that the main residence exemption, so that's the benefit that Australians get, that if they live in their house, their property, and they sell it, you don't have to pay capital gains on it because it's your main residence. Foreign residents used to get the benefit of this, but after the 9th of May 2017, that is no longer available to them. So again, keep that in mind, and you might have to apportion the gain for periods that overlap that date. Okay, so that's just the impact of residency upon paying tax. Now, the second part of this chapter is talking about how do you actually define an individual or company or trust, etc., as either a resident or non-resident. So the test is slightly different for individuals and then other entities. So first of all, for individuals. Now, these are all defined in Section 6(1) of Income Tax Act 1936, so they've been around for a long time. There's 4 key tests here, and it's basically an unusual one. So thinking back to how do we use these tests to determine whether an individual is a resident or not? An easy way to do that is to think back and think, what does the ATO want? The ATO wants as many people to come under as residents as possible because they're going to get this greater net over the over individuals and tax more items of income. So they're going to make it as hard as possible to be a non-resident through these tests. So that's how you remember that basically they need to fail all of these tests if they want to be called non-residents. However, it's otherwise they are residents for tax purposes. So the first test is the resides test. Now this one's often quite tricky to remember, and people get this confused with the domicile test. 3 and 4 are a bit easier, they're quite specific. But basically what this is saying is the resides test. So if the person is a resident, they are a resident, Australian resident for tax purposes. Now, how do they define residency? It's not actually defined in tax law, which makes it difficult. So it's just based on certain case law and general definition of what is a resident. So, and you can see that here, how that's that idea was defined in FCT versus Miller. So again, you're going to have to use case law to support your argument as to whether an individual is a resident or not. So probably the first part is the intention or purpose of present. Why are they staying in Australia? Are they staying for a holiday, or are they staying more permanently? History, frequency, regularity, and duration of visits. For example, if someone's only coming once a year, it's hard to argue that they'd be a resident. However, if they're coming every 2 weeks, they're starting to fall more into the Australian resident category. Family and business employment ties. Obviously, if they have family living here, they're more likely to call this Australia home. The other section is business and employment. If they have a job here, it's quite hard to argue that they're not a resident of Australia, because that's where they spend the predominant amount of their time, their income, etc. Social and living arrangements. So if they've got a lease here, or if they're living in a home, if they're just staying in hotels, for example, you're more likely to say that they're a non-resident. But if they're actually staying here, they've got a house here, etc., tends to suggest that they're a resident. Maintenance and location of assets. So if they have a motor vehicle here, you generally wouldn't do that if you're a non-resident, because your car's going to sit there and get a flat battery. And if you've got a bank account here, if you're just going on a holiday overseas, you're not going to have a bank account. If you're living here more permanently, you probably will have a bank account. So again, it's more just looking at the facts of the case and applying these relevant things to see whether they pass the resides test. Now, if you look up here per FCT versus Applegate, there's another small rule here that this resides test is the most important test out of any of them. So basically, if the person passes this test, they're a resident. You don't even need to consider the other tests. This is the most important one by far. If there's some, if you're not quite sure about this one, or maybe they've failed this test, you can start moving on to these other tests. Now, the domicile test is the more confusing one that I was telling you about how it's different from the resides test. So domicile is more to do with the concept of a home. So resides is where someone is staying. A domicile is more of a home. So, for example, you could be an expat overseas and have a house in Australia. If you're talking about that, you're going to be looking at the domicile test. But if they're residing, if they're spending the majority of their time overseas, they could be a resident for that particular year. That's kind of how I remember the difference between the two. So let's look at the definition for a domicile test. So a resident is a person whose domicile, i.e. home, is in Australia. So some of the facts, again, in FCT versus Applegate that you need to consider when looking at the domicile test is, what was the intention and actual duration of the taxpayer's stay overseas? Were they intending to return, for example? So a lot of these are around intention, a mental aspect. So it's it's really hard to get that in real life, but in the question they'll generally tell you what their intention was. Whether the taxpayer intends to return to Australia at some definite point in time, there could be an expat planning to live there overseas, or an expat staying for a couple of years with intention to return, the latter being that they're probably a resident of Australia for a domicile test. Whether the taxpayer has an established home outside Australia. So if they have a property outside Australia, they're probably more likely to be a non-resident under this test. Okay, so now we're getting into the slightly easier test, so the 183-day test. It's basically, if they've been in Australia for more than half a year, they're a resident. So you just need to count the number of days that they've been in Australia. If they've been here over 183 days, they're an Australian tax resident. Number 4, superannuation fund test. If a person is a resident if they are a member of a superannuation scheme for the Commonwealth Government of Officials. So that's basically any Australian super fund. If they're a member of this super fund, they're an Australian resident. That's a hard one to get out of if you have a job in Australia. Okay, so that's the 4 tests for residency for individuals. Now, it's probably helpful to do some of the activities for these ones, just so you can see how that interrelates with the actual case facts, and I'll do some of those for you in a separate video as well. But let's continue with the theory, and we'll move on to the same test but for companies, and then we'll move on to other entities as well. So companies are a little bit different. So there's 2 tests. The first test is really simple, and it's rarely the final answer in an exam question. So if a company has been incorporated in Australia, so if it's on the ASIC files that they're registered in Australia, that means that they are an Australian resident. However, most exam questions have a question where the company is registered overseas, incorporated overseas. However, if it carries on a business, and this is a bit of a conceptual phrase, you're going to have to prove that they're carrying on a business, then they are an Australian tax resident. For example, Apple subsidiary might be incorporated in the US, but the fact that it's carrying on a business, it's got stores in Australia, it's making revenue in Australia, that subsidiary will be defined as an Australian tax resident, and they'd have to pay tax on any income derived in Australia. So there's 2 aspects to this second part. So first of all, whether or not central management and control operations are in Australia. And the second part is B, voting power is controlled by Australian shareholders / residents. Now again, central management and control. Going back to the Apple example, their management might be in the US. However, if you look at the case of Malayan Shipping Co. versus FCT, a passive investment business tends to be carrying on business where the central management and control is undertaken. So the same position may also apply for an active trading business. So it's the key words here are the management. So if you look up here and you say where effective controls is in AU, then central management and control is considered to be in Australia, regardless of whether there is a foreign board, which is just a rubber stamp for decisions. Again, that's also Malayan Shipping Co. So, for example, in the Apple example, so they might have a board over there which puts a stamp on a capital investment in a certain store in Australia, etc. However, if management in Australia is actually driving the operational decisions, they're looking at KPIs here, they're talking to staff and hiring staff on the ground, then yes, the board and technical management is in the US. However, under using the guidance set out by Malayan Shipping Co., effective controls is in Australia because they are the people actually running the business. So it's a little bit tricky. So you got to read more. You got to read between the lines. So even though it might say that the management is overseas, you need to actually consider who's actually deriving everyday business decisions. And if it's in Australia, then it's actually an Australian resident, and they must pay tax on Australian income. Okay, so just quickly going over some other tests for different other entities. So for example, trusts. So trusts kind of follows a very similar structure. So you can see here, part 1, who's the trustee? Are they a resident? If they're a trustee, an Australian resident, then they're an Australian. Then the trust itself is an Australian resident. The second part then looks at the control and management and control of the trust. So again, this just follows the same approach as companies. You've got to consider where the business is carrying on business, regardless of whether it's active or passive. You got to look at where central management, control, and operations are located, and you got to read between the lines and see where is effective controls actually operating. Now, the next entity is Australian super funds, and this one's a little bit different. It's just a simple test. It depends on whether it's a complying super fund or not. And there's the section reference. So they'll generally tell you that in a question. And we'll talk about a little bit more of this later in the superannuation section. And then the final one's just partnership. So this isn't actually relevant as to whether the entity itself is a resident or not, because for a partnership, each partner is taxed on their own share of the partnership income. So it really depends on each of the partners what their residency status is. So the next part we're going to talk about is where each section, each source of income is actually derived. And this is really relevant because, yes, you might have determined that you're a non-resident, for example, but if you remember from the section before, non-residents are only taxed on Australian-sourced income. So if you're a non-resident and you can prove that your revenue is actually sourced in, the US, you won't be taxable on that income. Now, some of these can be quite arbitrary and can be quite difficult to prove one way or another. So a lot of money and a lot of tax comes down to some of these case law, hence why there's so many different specific cases on defining the source of income. Now, what I probably recommend for you is just to read through each individual one and kind of refer back to that section as you come in. For example, you might have a question on the sale of shares in the US, in which case just refer back to this section in the notes, go to sale of shares, here's your relevant case law, or if there is a section in the Income Tax Act, refer to that. And then just look what it says here. So generally the place where the sale contract entered to. So the contract, so just go back to your question, it'll say something about the sale contract and which country that was entered into, and that'll be your answer. But you also have to consider where the company conducts operations, amongst other factors. So I'll just quickly read through these, but most of them are self-explanatory, and you can just apply them to the case facts in your question. So, sale of goods, where the contract was entered into and value was added. Sale of shares, we mentioned that one already. Sale of other property, so where the property is located. So it doesn't matter where you signed a contract, for example, as it might do with sale of shares, because it's really dependent on the actual property itself and where that's located. Services, so where work is performed, except for this very important exception, when the work is specialized or can be performed anywhere, for example, a digital service. Then it's number one, where the service contract was entered into, or two, where payment for services was made. So really apply both of these different scenarios to your question, depending on what it actually says in the case facts. Dividend income, so that's where the profits were made from which the dividend is paid. For example, a mining company paying out a dividend will be where they've mined the ore. Interest income, so where the contract was entered into or where the funds were advanced. Lease contracts, where the property is located, very similar to this one up here. However, in the exception where it's not for leased real estate, for example, it could be the lease of equipment, it's where the lease contract was entered into. And the last one, royalty. So if the right relates to the use of property, then it's where the property is located, similar to the other property questions. Or if it's the right to use intellectual property, it's where the contract is entered to. So you kind of see this theme between physical goods like property and also digital or intellectual properties which can't be allocated to a specific physical spot in the world. It's usually where the contract relates to. And that's the end of part 2 of chapter 1, which is residency. So move on to the next video shortly, and if you have any questions, let me know.